double entry accounting. Let's now move on and include GST to the transactions and see the impact using double entry accounting. This increases the complexity of the recording process. And we're going to assume that the GST clearing account is a liability account before every transaction, and this is normal for most business situations. So the first transaction is on the 1st of the 5th. We paid $2,200 for a computer which included $200 GST. So that means our bank must have been reduced by the full amount, $2,200. So credit entry, that reduces the asset. You write the name of the accounts that are affected, in this case it's computer, $2,000, and it's also GST clearing, $200. Now you could put that on the one line if there was enough space. So two credits here, $2,000 and $200 to reduce the bank by the full amount, $2,200. Now those two credits are matched by a debit to the computer account to increase the value of the asset, cross-reference bank, value $2,000. So you debit computer $2,000 to increase the value of the asset, and the other debit goes to the GST clearing account, cross-reference bank, $200. That reduces the value of the liability. Because the business has paid $200 GST, it reduces its GST commitment to the ATO, the Australian Taxation Office, so it's a debit entry to reduce the liability. So in this exercise, or this transaction, there's two debits. One to computer $2,000, one to GST clearing $200, and that matches with the two credits to the bank account, $2,000 there, $200 there. The total value of the debits equals the total value of the credits. So 2,000 plus 200, they're the debits, equals 2,200 credits. Let's move on to the next transaction. Here we pay rent, $3,000 plus $300 GST. So this is going to impact on the bank account, the rent account, and the GST clearing account. So we'll go to our bank account, and we're going to reduce it because we've just made a payment, and we've paid rent, $3,000, and we've also have to record the GST on that transaction, which was $300. So they're the two credit entries to the bank account to reduce bank by a total of $3,300. You could put that on the same line if there was enough space, but you've reduced bank by $3,300 by doing a credit entry or two credit entries. Rent is an expense, and expenses are increased by debit entries. So debit bank, debit the rent account, cross-reference bank, value $3,000, and you also have to record a debit to the GST clearing account, there it is, to reduce the GST liability by $300. So there's one debit, $300, another debit, $3,000, which equals the two credits, $3,000 there, $300 there. The total value of the debits, $3,300, equals the total value of the credits, $3,300. Let's do a cash sale transaction, but for the moment let's just not worry about the cost of sales. We'll do that later. So let's record the cash sale, $6,000 plus the GST received, and see how that's going to affect the ledger accounts. We've just received $6,600 on the 3rd of May. So we debit bank and we write sales, $6,000. And we also write GST clearing $600. You can put that on the same line if there was space. So you've increased your bank by $600 plus $6,000, $6,600. Those two debits are matched by credits. So in the GST clearing, on the 3rd of the 5th, credit entry to increase a liability, $600. And in your sales account, to increase a liability, to increase a revenue, you always credit it, and you go write bank, and you're going to write the value, which was $6,000. So they're the two debits, $6,000 and $600, matched by the two credits, $600 there and $6,000 to the revenue account. Come back and see the next video.